In 3 days, the most powerful financial institution on earth will make a decision that affects every stock, bond, savings account, and crypto price on the planet. The Federal Reserve meets on April 28th and 29th, and what they decide about interest rates will set the direction of markets for the rest of 2026. Here's everything you need to know before it happens, and exactly what it means for your money. Before we go further, nothing in this video is financial advice. Signal Markets is an educational channel. We look at publicly available data and research to help you understand how markets work. Always do your own research and speak to a qualified advisor before making any investment decisions. Let's start with the basics, because even if you've heard of the Federal Reserve, most people don't fully understand what it actually does. The Federal Reserve, often just called the Fed, is the central bank of the United States. Think of it as the bank that controls all other banks. It doesn't lend money to regular people like you and me. Instead, it controls something called the federal funds rate, the interest rate at which banks lend money to each other overnight. That might sound technical, but here's why it matters to everyone. When the Fed raises that rate, borrowing gets more expensive everywhere. Mortgages go up, car loans go up, business loans go up. Companies spend less, hire less, and the economy slows down. That's intentional. It's how the Fed cools down inflation. When the Fed cuts that rate, borrowing gets cheaper. More money flows into the economy. Companies invest more, people spend more. Asset prices like stocks and crypto tend to rise. Right now, the Fed funds rate sits at 3.5 to 3.75%. That's where it has been since early 2026, unchanged across 2 consecutive meetings already in January and March. And on April 29th, the overwhelming consensus, we're talking 99.5% probability according to prediction markets, is that the Fed will hold rates there again. But here's the thing. Whether the Fed holds, cuts, or hints at future moves, every word of their statement will move markets. Understanding why is the real signal. So, why is the Fed holding rates instead of cutting them? To answer that, we need to talk about what's happening with inflation right now, because it has not behaved the way anyone expected. Back in early 2026, inflation in the United States was sitting at around 2.4%. That was close to the Fed's 2% target. Rate cuts looked likely. Markets were pricing them in. Then March happened. The March Consumer Price Index, the CPI, which is the main measure of inflation, came in at 3.3% year over year. That's the highest reading since 2024. And in a single month, it jumped 0.9%, the largest monthly increase since 2022. What caused it? 3 things. Number 1, energy prices. There is an active conflict in the Middle East involving Iran. Oil prices have surged as a result. When energy prices go up, everything gets more expensive. Transport, manufacturing, food. It flows through the entire economy. Number 2, supply chain strain. The conflict has disrupted shipping routes and created knock-on effects in global supply chains. That pushes costs up for businesses, who pass those costs to consumers. Number 3, and this is the interesting one, the U.S. economy is actually doing well. March non-farm payrolls came in at 178,000 new jobs. The unemployment rate edged down to 4.3%. A strong job market means workers have money to spend, which keeps demand and prices elevated. So the Fed is caught in a difficult position. The economy is solid, but inflation is running above target. And the main tool for fighting inflation, raising interest rates, risks slowing that healthy economy down. Their answer, for now, is to do nothing. Wait. Watch. And that is exactly what we expect on April 29th. Let's get specific. What does the Fed holding rates at 3.5 to 3.75% actually mean for your money? For savers, if you have cash in a high-yield savings account or money market fund, you're still earning a reasonable return, somewhere between 3 and 4% in most cases. That's actually not bad by historical standards. Holding rates keeps this in place. For mortgage holders and home buyers, rates stay elevated. The average 30-year fixed mortgage in the United States remains above 6.5%. If you were hoping for cheaper mortgages this year, the Fed's holding pattern pushes that hope further out, likely to late 2026 at the earliest, according to J.P. Morgan's economists. For stock investors, this is where it gets nuanced. Markets have already priced in the hold, meaning the hold itself won't move stocks much on Wednesday. What will matter is the language Powell uses at his press conference. If he sounds more worried about inflation, what traders call hawkish, stocks and crypto could fall as rate cut hopes get pushed further away. If he sounds more open to cutting later in the year, what traders call dovish, we could see a relief rally. For crypto investors, Bitcoin is currently hovering around $78,000, and it is highly correlated with the S&P 500 right now, at a 0.65 correlation, the highest in 2 years. That means crypto is behaving more like a risk asset than a safe haven hedge. If stocks fall on hawkish Fed language, expect crypto to follow. And for gold, gold has been the standout performer through this period of uncertainty. Energy prices up, conflict in the Middle East, and inflation fears have all pushed investors into gold as a safe haven. The Fed holding rates doesn't hurt gold. If anything, ongoing uncertainty keeps the case for gold strong. So, when the announcement comes on Wednesday, April 29th at 2 p.m. Eastern Time, here are the 3 things to watch that will actually tell you what happens next. Signal 1, the official statement. The Fed releases a written statement the moment the decision is announced. You can read it at federalreserve.gov. Look for 2 things: how they describe inflation, elevated versus somewhat elevated matters, and whether they add or remove any language about the Middle East conflict. The March statement added a line saying the implications of the conflict are uncertain. If that line gets stronger, it signals the Fed is more worried than before. Signal 2, Powell's press conference. This starts around 2:30 p.m. Eastern. Jerome Powell takes questions from journalists. Listen for whether he mentions the possibility of rate hikes. Even a hint of that language would be a significant market mover. Also, watch for his framing of inflation. Transitory versus persistent. Persistent is the hawkish word. If he uses it, markets will react. Signal 3, the dot plot. The Fed publishes its summary of economic projections, which includes what each FOMC member expects rates to be at the end of 2026. The March projection showed 1 rate cut for 2026. If that number goes to 0, meaning no cuts expected this year, that would be a significant hawkish shift and could move markets sharply. Here's the bigger picture that most coverage of the Fed misses. The Fed's decision doesn't happen in isolation. It is one piece of a global macro puzzle. And right now, that puzzle has several pieces all moving at once. Energy prices, driven by the Middle East conflict, are the wild card. If oil prices stay elevated or go higher, inflation stays sticky. And the Fed can't cut. That keeps pressure on stocks and keeps gold elevated. But if the conflict de-escalates and energy prices fall, inflation could drop quickly, and the Fed would have room to cut rates. That would be a major positive catalyst for stocks, for crypto, and for risk assets broadly. JP Morgan, Goldman Sachs, and most major institutions are all saying the same thing. The Fed will hold through most of 2026, with maybe 1 cut late in the year. The question isn't if rates stay high, it's for how long. That matters because the longer rates stay high, the more pressure builds on corporate earnings, consumer debt, and economic growth. Watch the jobs numbers every month. If unemployment starts rising above 4.5%, the Fed will cut, regardless of what inflation is doing. That is the real signal to track. That's your complete picture of what the Fed is doing, why they're holding rates, and exactly what to watch on April 29th. To summarize the key points, the Fed holds rates at 3.5 to 3.75%. The third consecutive hold. Inflation is back at 3.3%, driven by energy prices from the Middle East conflict and a resilient U.S. economy. What matters most is Powell's press conference language. Watch for hawkish signals on inflation or dovish hints at future cuts. And the bigger signal to track all year, U.S. unemployment. If it rises, cuts are coming. If it stays stable, rates stay higher for longer. If this kind of analysis is useful to you, connecting what the Fed does to what happens in your stocks, your crypto, and your savings, subscribe to Signal Markets. We break this down every week without the noise. And if you want to start putting money to work in the markets we discuss, stocks, ETFs, crypto, I'll leave a link below to the platform I use. As always, do your own research first, and remember, nothing in this video is financial advice. This is Signal Markets, Find the signal, ignore the noise. See you next week.